So, good morning, Nick.
Morning, James. Thank you for having me.
Good. So you can hear me again as well now as well. This 316 is perfect. All very
It
helpful.
does help.
Yeah. Cool. So as usual, I'm going to let you fire away and just tell us a bit about the fund, please, and then we'll get to some questions.
Yeah, very happy to. So I'll do a sort of elevator pitch and then just drill down to some of the themes we're playing. And then, yeah, very happy to answer any questions. So I suppose just very quickly on the team, there's five of us that sort of live, drink, eat, sleep financials, 24/7. We've got a few other colleagues that love the sector as we do. So we're really pleased we've got a in-depth team. Tom Dorner just joined us back in December. He was at Aberdeen Standard Life as a fund manager analyst, and prior to that, sell side insurance analyst at Citi and Lehman. So he's been a great addition to the team and massively contributing. So going over the page, we run three funds. I sort of jokingly call them, skimmed, semi-skimmed, and full-fat versions of financials. Today we're focusing on that semi-skim version being the investment trust. Just a little bit of history. It was launched 10 years ago as an income and growth vehicle, give you exposure, a low risk way of playing the recovery in global financials with a yield at launch of about 3%, a little bit lower today. That dividend on average has grown about 5% per annum. I mean, it's been increased for about 7 out of those 10 years. It's never been cut. So, a good combination there. And of the three, as you can see, it's very much an equity fund, though we do have a small bucket to hold bonds, obviously to take advantage of opportunities as we see them there. And if you flip over the slide, just to really sort of drill down to, what is it we're trying to provide? We're providing that exposure to the sector. It's the second largest globally. It's giving you exposure to banks, insurance companies, diversified financials, and latterly fintech, which came to our sector this time last year. And you're looking at what we believe is some fantastic businesses in the sector. Many with sort of oligopolistic characteristics, some with a history dating back 150 plus years, and you're getting exposure to a lot of different trends, not just, even though when you think of it, it's a cyclical sector, within that, we sort of try to drill down to some of the themes that you can take advantage of. So more recently, obviously, the attraction has been around the higher for longer, the impact of higher interest rates on margins for banks, on higher investment income for the insurance companies. But growth in asset management, wealth management, obviously increase in wealth, which the sector is benefiting from. Trends in insurance, which we'll come on to in a minute. You've got exchanges in there, rating agencies, and of course, some of these smaller fintech companies and obviously larger payment companies like MasterCard and Visa are very well known. So, what are we looking at the moment? Well, just to sort of touch on performance before we get into that, when you think about the sector. So, despite the perceptions of volatility, it's delivered actually really credible returns over the last 10 years. So you're looking at around 9%, despite some of the headwinds around the beginning of that 10-year period around capital and regulation, and then low and negative interest rates. But when you look from the sort of when we did a corporate action back in 2020 to extend the life of the trust indefinitely, and we'll come on to the attractions of what that means now from looking at the shares of the trust. You've had close to almost 20% returns annualized from that period. And so the sector's actually done better than the wider equity market, whether you're looking at the FTSE All Share or whether you're looking at the MSCI Acqui, at the bottom of this page. The other thing we often highlight when we talk about the trust is the performance of UK financials and UK banks. Always try and look at the sector. Don't look at it through the lens of what's happened with UK banks. UK banks had been a good place to be in the last 3 or 4 years. They performed really well, but over a longer period, you'd have missed out on some really, really good returns when looking at the sector as these numbers detail. So flipping over the page, then what are some of the themes that we're playing at the moment? Alternative asset managers, there's significant structural tailwinds there, which we'll come on to. Very topical at the moment about the demand for private equity and private credit. We think there's some those tailwinds will continue. We'll sort of go into that in a little bit more detail. Reinsurance, but also we could perhaps touch later in the Q&A on what's happening in the motor insurance market. We'll know that insurance costs have gone up materially in recent years, so the sector is benefiting from that. Emerging markets, long term, we've always liked the sort of India, Indonesia, the low penetration of financial services in some of these emerging markets. You can see strong tailwinds. But lastly, there's opportunities around reform, and we'll touch on Korea there. Small and big cap opportunities. You've seen in the UK that M&A has picked up quite markedly in the last few months. So if we can buy good companies trading at attractive levels, then there's the potential for some icing on the cake here if anything came through. And then banks, which are obviously critical, important part of the sector as well. I think here at this point in the cycle, we need to be much more selective. Concerns about commercial real estate, unrealized losses for some banks on their balance sheets. Equally, they're benefiting from the higher for longer. So we'll go into that. So on the alternative asset managers, why is it that we like these? I mean, to start off with, if you give a dollar of money to whether it's ourselves, whether it's a Fidelity, a BlackRock, a Schroders, or whatever, because of the daily liquidity of most funds that traditional asset managers manage, that money can go out the door the following day. The difference with the alternative asset managers, you give them a dollar of investment, and that's locked up for 5, 10 plus years in their sort of semi-permanent vehicles. So you've got an asset base which is very sticky. The reason for obviously the flows going into this asset class is returns have been by and large, very, very good. They're giving you access in some cases to parts of the investment opportunities that you perhaps can't access so easily in listed markets. And as these businesses continue to expand into other areas, not just pure private equity, but private credit, infrastructure, real estate, and so forth, then there's huge opportunities for these businesses to continue to grow. Infrastructure is probably one of the more latter ones where some of them have been growing. BlackRock, towards the end of last year, made a big acquisition here of buying GIP, which is a big global infrastructure player. And you pick the number out of your hat. The trillions of dollars that needs to be invested into this space. Again, this is an opportunity set that this sector is going to benefit from as well. So we like that. On the next slide, reinsurance. So reinsurance, the bookie's bookie, as it's known. When you think about, you're taking out your home or car insurance, who does Admiral or Direct Line? They go and then reinsurance some of that risk. That might be with some of the big reinsurers like Munich Re or Swiss Re. It could be through the Lloyd's market or some of the Bermudan insurers. And the attraction of the reinsurance market at the moment is twofold. Firstly, how do insurance companies make money? They make it from a combination of investment returns, where they invest their cash and bonds and free float, which is there to pay claims, and then underwriting returns. Now you've seen with the yields and interest rates going up after the last couple of years, the investment returns that the insurance companies are making has gone up quite rapidly. So they've been locking in some good returns there. And secondly, underwriting returns have improved as well. And that's a combination of reinsurance rates going up, in this case for reinsurers, and you can see that on the chart. And that's really a function that reinsurers haven't been hitting their cost of capital up until the last few years. Increased frequency of catastrophe events or secondary perils, as they call it, as well, like wildfires and rainstorms, has meant returns have been poor. They've pushed up reinsurance rates. And the other critical factor is they've raised what you call attachment points. So the level at which before a primary insurer can claim against his reinsurance has gone up. So some of those, what you call attritional losses from secondary perils that reinsurers have been paying for, and are now being borne by primary insurers. Again, a reason why you're seeing insurance rates go up so much. And now you're seeing some of these reinsurance companies make much more attractive returns. And we see that as sustainable for the next couple of years, and share prices perhaps not pricing that in. On the emerging market front, I sort of touched on this briefly around some of the longer term themes we've liked, like India and Indonesia, but perhaps an interesting tilt here, which is slightly different. Japanese stock market has done very well in the last couple of years, driven obviously in part by some of this corporate governance reform. Also, obviously, expectation of higher interest rates and the impact that has on their markets. You're seeing something similar in South Korea. And as the table on the right shows, you've got, it has been the risk has always been it's been a value trap. You've got a lot of companies, trading at low valuations. In some cases, make UK financials or UK banks look expensive when you look at some of the South Korean banks. And the government, which has got fairly bipartisan support, has been putting forward some corporate governance reforms here around capital return, around how you interact with shareholders. There's been proposals perhaps to change tax that will allow some of the large conglomerates easier for them to be broken up. Now there's been a bit of volatility around recent elections and the degree to which the opposition parties support some of the more positive measures that we're seeing coming through here. But the fact that there's largely support on both sides of the aisle in Korea, we think is positive, and so that's where we've taken a position in a couple of banks, Shinhan Financial being one of them. Over the page, sort of small mid-cap opportunities. Sort of touched on this. Small mid-caps have obviously lagged to a significant degree globally. Obviously the Mag 7 or large caps generally, when you look within the financial sector, it's the large US financials that have done particularly well, not just due to good operating performance, but also from seeing an improvement in their valuations. And so we've been trying to find some opportunities here where we can find good companies that we like, where we think valuations discount their long-term value. Consequently, we've increased our exposure to the UK here. So we have exposure to two examples: OSB Group, what was called One Savings Bank, IG Group, the spread betting business, and we've got others as well, which don't solely touch on this theme, but have exposure to other themes as well, where we think there's some interesting opportunities. Also, what's here is worth highlighting, this whole interest around alternative asset managers, is the whole flywheel of capital markets reopening this year, with debt markets doing well. You've seen a few IPOs start to come through. So again, we took advantage and pivoted towards some of the more investment banking banks within the portfolio to take advantage of that, and that's been helpful. On the next slide, I suppose really we sort of just touched on banks and our thoughts there. So as a sort of high level, we are overweight at the moment in European banks within the trust portfolio. We're underweight the US. The themes around that on the right here is you can see the capital return story for European banks is prodigious. We're showing what's coming back to shareholders potentially over the next 3 years, and you're looking on average about a 30% return to shareholders through buybacks and dividends. And that reflects a combination of balance sheets are very strong. And because of the rise in interest rates in the last couple of years, European banks are making much better returns. Their ROEs have gone from single digit to low to middle teens, mid-teens. And that increase in profitability when the banks themselves aren't growing their loan books very fast, lack of demand, has resulted in them, the only option they have is to either look to return it to shareholders or perhaps use it for M&A purposes. So you've got that good combination of profitability coming out plus improvement in capital return, and that's led to European banks performing very, very well over the last 3 or 4 years. And we continue to like that. If we flip over the page, one of the concerns why we've been more cautious on the US is this concern, two concerns. One about unrealized losses on balance sheets. This is the mark to market of securities portfolios on banks' balance sheets. So this is the issue around Silicon Valley Bank and First Republic last year. We don't see that as a systemic concern, but it is an overhang. Our bigger concern is around commercial real estate. Now, the issue here is commercial real estate is obviously a very, very large market. The real concerns has been focused on the office, which we highlight on this slide. When you then drill down to office commercial real estate, actually exposure that banks have to it is pretty small, and it's very, very manageable. So we don't see this as a capital issue, but we do see it as a bit of an earnings headwind. Now, saying that, banks have taken significant provisions for their office CRE. So for the large banks, on average, they're assuming 1 in 5 of office CRE loans defaults, so 20%, and they'll lose 50% on that loan. So 50% times 20%, they're taking sort of 10% provisions against some of their office CRE portfolios. Also, for just sort of general provisioning against where we are in the cycle, most banks are assuming in the US, using this example, unemployment will peak above 5%. So again, they've got buffers there. But even though we don't see this as a sort of capital issue for the banks, we just think it's a headwind for the sector to perform until there's more visibility on the outlook for the US economy into next year and commercial real estate markets. Finally, on this slide, we might have shared it before for those who listen to us. It's quite a busy slide. What are we trying to show here? We've taken nearly 30 years of data for global banks. Every single month over that 30-odd years, what was the price to book of global, a portfolio of global banks? So ranging from close to 0.5 times up to sort of 2.5 plus. If you had bought a portfolio of global banks in each of those months, what was then your subsequent 3-year return? And what the chart is trying to highlight is the lower the price you paid, the higher your return, and vice versa. Pre-GFC, banks traded on higher multiples, but that correlation was relatively strong. And you've got an even stronger correlation post-GFC. So banks have more capital, they therefore make less profit, return on equity. But ultimately, if you can buy a bank at a low valuation, the history, if this continues, if the correlation continues, suggests you actually make pretty decent returns. Today, banks are trading between 1 to 1.1 times book. If you look at this chart, that would suggest returns anything from 15 to sort of 50% over the next 3 years. And in a market where valuations generally for equity markets are close to all-time highs, what this highlights is actually there's still tremendous value within bank shares. Just some quick stats overall on the portfolio itself. Again, this just reiterates, even though we think the sector's got a lot of great companies within it, you're buying it, in our case, for less than 11 times earnings. For decent, in some cases, double-digit earnings growth coming through, using Bloomberg forecasts. And relative to a market that I think for the MSCI equity world is trading around 18 times, and you've got quite a significant discount and buffer should there be any volatility in markets going forward from here. There's some style analytics there. Just to highlight, we've increased our exposure to some of the value stocks within the sector recently, but historically we prefer, we like the big, good quality, financial franchises. If it's a bank, it's got good funding, it's got good profitability. If it's insurance, it's a good underwriter, and so forth. And then to wrap up on the portfolio, again, it is a global financials fund. You look on the right-hand side, you'll recognize, the majority of those names. They're very, very well-known financial businesses. Chubb, perhaps a little bit less well-known on this side of the Atlantic. It's one of the biggest insurance companies in the world. It's not the locksmith, but you're getting that broad spread of banks, diversified financials, and insurance companies. On the left-hand side, the exposure, again, reflecting global markets, is very US focused. But again, we've got, exposure elsewhere where we like Europe, we highlighted earlier. We've got a little bit of fixed income at the moment, which is giving us some good returns. And the trust being geared has been anywhere from sort of 0 to 13, 14%. It's at the lower end at the moment on the back of the run-up in markets. So with that, I'll just sort of final comment where the trust is today. We're trading, I believe, on a sort of 8-9% discount. There's a key liquidity event coming up in June next year. There's 5 yearly tender offers. That's how the trust is structured. 100% of the trust can be tendered at NAV, less a little bit for costs. So what we'd hope, obviously, we can't say what the share price or NAV will be in a year's time, but certainly that discount we'd expect to be smaller than it is today. So that reduces the downside risk, all things being equal, between now and then. So with that, thanks, James, and very happy to.
Great, thank you, Nick. Yeah, cool. And so a couple of just questions about how you run the portfolio first. So there's a very general one about just how you select stocks for the portfolio.
Yeah, it's a really good one. I mean, we have, as you'd expect, we have a lot of spreadsheets and models set up, which screen the universe. Some of those might be for different subsectors where we're using different sort of financials or different characteristics of what we're looking for. But for a bank, it's a classic one. What do you want? You want a bank that's got good capital ratios, good liquidity, makes a good return on equity, and yet fundamentally is a good underwriter of risk, and those are some of the, I suppose, key attributes we look for. Now, around that, there's going to be opportunities where we might buy something that's not more of a trading opportunity. But we're just trying to find things where we think, it's balancing that mixture between what we think are good long-term winners, where are going to compound book value or earnings or, whatever it is, around more shorter term, trading opportunities where things are, let's say, more in the value basket, maybe not quite, not as good, but where we think the market's overly discounting. So, I mean, 2 examples recently, we've got holdings in Barclays and Citigroup. Both haven't performed well over the last 5 or 10 years from the point of view of share price, total return, and just operating performance. But we think, we see in both that the bar is low for them to beat estimates out there, and there's an opportunity there to play those. So that's how I suppose it's been, when you look at the attribution for the trust, it's very much been driven by bottom-up stock ideas, not necessarily by sector asset allocation or macro calls at the top. And you're just trying to marry up those ideas from around where we're finding interesting opportunities, and then balance that from a risk perspective across the portfolio.
Okay, cool. In terms of this sort of small cap, large cap balance, and you talked about the opportunity in small cap, but is that something you consciously manage?
I wouldn't say consciously. I mean, historically, we've had a lot in some of the US small and mid cap regional banks where we've made some very good money. Consequences, just where we are at this point in the cycle with concerns about commercial real estate. US regional banks are obviously are more sensitive to obviously the economic cycle. So that's one where it's we'll look to buy into those when we're more more positive on the where the path of the US economy and commercial real estate goes. But it's more a question of just finding interesting opportunities. I mean, we've gone through a period where it has been a case that the stronger have got stronger, as in that some of the large caps have done particularly well. I mean, if you look at the likes of Berkshire Hathaway or JP Morgan or American Express, they've been consistently outperforming. So actually, it's been a headwind to performance if you've had too much in small and mid caps, and we think that that's possibly turning, but we're trying to be quite selective about it.
Okay. Obviously, a lot of that is outside the UK. Do you try and manage the currency risk, or is that just something that comes with the investment decision?
Yeah, I mean, it does come, the risk comes with the territory. We do we're not looking to take currency bets, but what we have done is where we've got a big difference between our benchmark, that we might take out some currency hedging, or we might deposit some cash in Australian dollars or Canadian dollars where we got limited exposure at the moment, just to be conscious of those risks. But we're not we don't hedge back to benchmark. We're not conversely, we're not looking to take huge risks over and above, where the universe is.
Okay. Um, on the banks, you talked about commercial real estate, potential losses there, but generally, sort of slowing economies and potential rise of bad debts, is that something that is now sort of no longer an issue?
Uh, I would say we're at quite an interesting juncture. There's this, if we had this conversation 2 years ago, higher interest rates, undoubtedly good news for the sector. Lower negative interest rates, you'd have compressed margins, that squeezed profitability. We've had the reverse of that over, the last few years, especially for European and banks which have done well on the back of that, margins expanded. And the surprise has been the asset quality, bad debts has held up so well. You've had outside office commercial real estate, maybe a pickup in delinquencies, subprime, consumer lending in the US and other places. Actually, it's been very good. You had what you had in the pandemic, as a lot of banks put in place what they called a sort of COVID buffer, a sort of management overlay. We're going to take a bigger provision because we don't really know what's going to happen. This doesn't, models just don't work for this. And then it turned out actually bad debts didn't jump massively during COVID. So that COVID buffer became a cost of living buffer. And you're at the point now where some banks go, well, we can't continue to have this sort of excess sort of provision set aside. We're going to have to release it. But at the end of the day, if economies, we've seen some better data out this year, so you're not seeing a material deterioration in bad debts at all. But if the economy turns down, then that will change.
Okay, cool. On the reinsurers, I mean, it does feel like the environmental disasters keep getting worse, and I saw a prediction that there's going to be like a record hurricane season this year. I realize that if you have a bad year for losses, the rates go up, so that's good for
Yes.
profit down the line. But if the disasters keep getting worse, do these things make money?
Yeah, I mean it's I don't want to describe it as a Ponzi scheme, but it's an extraordinary where if rates go up and you don't have any hurricanes or whatever, or significant weather related losses, accidents, these businesses make good money. And if you do, something happens and losses come through, then rates go up even more, and people buy the shares, and they're going to make better money again. Ultimately, I mean, as the chart highlights, this is a very cyclical sector. Higher reinsurance rates leads to higher profitability. That drags in capital. Those rates start to soften and then fall, and profitability falls. People then start, being less cautious about underwriting risk. I mean, the big change that was touched on is that reinsurers have been increasing their insurance rates since 2017. And it wasn't really until last year was the first year where the companies themselves made decent, returns. And always the unknown is what's going to happen. The impact of climate change. You've had an increase in frequency, severity is worse. More building on coastal regions or floodplains. I mean, that is being factored into insurance rates, and there is issues in the US about people struggling to get home insurance, and that's a significant issue. And how do you square that circle? That requires politicians and policymakers to figure that one out. But ultimately, if you want private capital, they've got to make a return to make this industry work and provide insurance at a adequate cost that people can afford.
Oh, okay. Now, new is not a name that most people will know. There's a question here. So how do you balance the risk around this? Because obviously it's a fintech and it's LATAM, is that right? Emerging market risk?
That is correct. It's a digital bank in Latin America. I mean, what's extraordinary is it has 100 million customers already. And the concern that we've had, and we have been cautious on it, is with any of these fintech businesses, we don't think it's possible to reinvent the underwriting wheel. It's very easy to lend money. It's a lot harder to get people to pay it back. And there's this joke about buy now, pay later. It's, we buy now and charge off later. And then, that industry's had its questions, raised around it. So that's our concern. Ultimately, New is pushing into consumer lending and credit cards. And so far, it's actually proven to be done a reasonable job at it. But that's where the risk is. It is disrupting the market in Brazil. There's concerns the same will happen in Mexico. It's paying much higher deposit rates, but fundamentally, you've got to be cognizant. This is a balance sheet business. It's not like a payments business, like obviously MasterCard, Visa, etc. It is a balance sheet business, and therefore there's risks around that. And I guess you can earn fees around all the services you provide to customers, but you've got to be very, very cognizant of that, and that's something that we keep a close eye on.
Can you sort of update us on Berkshire Hathaway, please? The question here is about asking because Warren Buffett apparently said there's not enough attractive investment opportunities around. But just tell us a little bit about what the attraction is of that stock, please.
Yeah, so I mean, it's the largest stock in our index. I think I can't remember exactly. It might be the fifth or sixth largest company, the S&P 500. It has the biggest balance sheet of any company in the US. Employs 396,000 people, thereabouts, with business, famously across insurance, railroads, energy, utilities, with big investments in the likes of Apple, particularly, but American Express, Kraft Heinz, and so forth. And so it's huge. We've pulled back a bit recently in recent months. I mean, the reason we added to our holding last year is because of the tailwinds we're seeing in the insurance and reinsurance sector. And when you look at Berkshire's results, insurance has gone from generating about 25% of its profits 5 years ago to about 45% today. And it's just made a big investment in Chubb, which are also a big listed insurance company. So, yeah, Buffett made comments that have been repeated about he's struggling to find value. He's getting highlighted that buying back shares here adds perhaps it's less accretive than it has been before, and I think that's reflective of markets as a whole. Markets are by no means cheap, so it's a lot harder to find good value to put money to work. And he's just reflecting that. So in an odd way, you've got a great fantastic franchise here that owns some fantastic businesses. A couple of them have had headwinds around wildfires and litigation and utility business and regulation around that. But it's got a huge balance sheet. It's very, very high, highly rated. It's sat on $182 billion of cash and T-bills. It's the kind of company you want to own if you go into a volatile, period for markets or economies. In the short run, there's probably better value elsewhere, we think, within the sector, but it's still a great business. So I hope that adds a little bit of color to our thoughts.
Cool, thank you. Just coming back to Korea again.
Yeah.
Obviously, you've highlighted there's a lot of things that are trading on very cheap price to book valuations. There's corporate governance reforms, that's all tick, tick, tick. But do you actually need to be activist or have somebody in there being activist to unlock that value?
Yeah, so it's a good question, and this is obviously the one is this issue around Japan is from Abe's three arrows. It's taken nearly 10 years for some of those corporate governance reforms to feed through. It's a little bit different, I think, because it's got broad support from Korean companies themselves, and they're saying they're actually going to take on board some of these reforms, even if it doesn't necessarily come through legislation. And two possible catalysts, to help that. One is there's going to be an index of companies that meet, the criteria for some of these corporate governance reforms, and I think that's coming up in the next sort of 4 or 5 months. And the plan is towards the end of the year, an ETF will be launched. So there's a push there, and it seems to have good support from certainly the Korean banks that we speak to. So we think it should have legs, but nothing's guaranteed. So we'll see what happens.
Fair enough. Thank you very much. We covered a lot of ground. It's 11:57, so we've got to wrap up there. But thank you very much for today, especially for stepping in at the last minute. And we'll follow with
Great.
interest and talk to you again soon.
No, thank you, James. Thank you for having me. And
Cool. So next week, we're talking to the new manager of Majedi. They've had some results this week, so you can have a breather to see how I've been doing, but he'll kind of update you on that. And then just to flag, on the 21st of June is our next panel show. This is what we've been trying to nail down. So we're going to be talking about big discounts in the sector. And we've got some interesting guests on there already, I think, to talk to you. And then, as I say, we've got a long list of things going all the way through to October. So have a good week, and I will see you next Friday.